Imagine you just bought comprehensive car insurance for the first time. Full coverage, zero deductible, every scratch, every dent, every fender bender completely covered. Now ask yourself honestly, do you drive exactly the same way you did before? Do you park with the same paranoid precision? Do you slow down quite as carefully in a rainstorm? If your answer is anything other than a pure, unconditional yes, congratulations. You already understand moral hazard. You just didn't have a name for it. Moral hazard. It's one of the most important ideas in all of economics, and almost nobody outside of a finance textbook has ever heard of it explained properly. But here's the thing. It is happening to you right now. It shapes how your bank operates, how your employer behaves, how your government makes decisions in a crisis. It is the invisible engine behind every financial bubble that has ever popped, every institution that has ever been declared too big to fail, and every bailout that has ever cost the taxpayer billions. Understanding moral hazard doesn't just make you smarter about the news. It changes how you read every contract you sign, every loan you take, and every promise any institution makes to protect you. Let's start somewhere simple, somewhere almost embarrassingly every day. You rent an apartment. You pay a security deposit. Why does the landlord ask for that deposit? Not because they hate you, because without it, you have less incentive to treat the apartment with care. The deposit is the landlord's way of saying you need skin in the game. That phrase, skin in the game, is the key to everything that follows. Moral hazard is what happens when someone is protected from the consequences of their own risky decisions. When the downside belongs to someone else, the incentive to be careful quietly disappears. It sounds obvious when you say it out loud. And yet, over and over again, in housing markets, in banking, in international finance, in healthcare, we set up systems that do exactly this. We remove the skin from the game, and then we act surprised when people stop playing carefully. The term itself is old. It comes from the insurance industry. 19th century actuaries and underwriters used it to describe a very practical concern. The moment you insure someone against a loss, you might be creating the very behavior that causes the loss. A warehouse owner who insures his building for twice its market value suddenly has a new kind of interest in a fire. Early insurance companies noticed this pattern and called it a moral hazard. A hazard that arises not from physics or weather, but from the moral choices of the person being protected. The irony that economists later pointed out, and it is a deep irony, is that moral hazard has almost nothing to do with morality. It isn't about bad people. It is about incentives. Given a certain structure of protection and consequences, even perfectly ordinary, reasonable, well-intentioned people will systematically take more risk than they otherwise would. That is not a character flaw. That is just math applied to human behavior. So, how does it actually work? Let's build it step by step using the clearest example available: health insurance. Suppose you have no health insurance. When you go to a doctor, you pay the full cost out of your own pocket. Every visit, every test, every prescription comes directly out of your bank account. Under these conditions, you think carefully about whether a visit is really necessary. You ask about cheaper alternatives. You follow through on preventive care because you understand that an ounce of prevention is literally cheaper than a pound of cure. Now you get health insurance. Your employer covers most of the premium. The regular fee you pay to be insured. Your copay, the small amount you pay per visit, is $20. Suddenly, the full economic signal of a medical decision is gone. You go to the doctor for things you might have waited out before. Your doctor, knowing you are insured and that the insurer will cover his fees, orders tests that are probably unnecessary just to be safe, because safe costs him nothing. The insurance company pays more claims. Premiums rise. Everyone in the system is behaving completely rationally given their individual situation. And the collective result is a system that costs far more than it should. Nobody is cheating. The structure of the incentives did this. This is the mechanics of moral hazard in pure form. There are always two parties. Party A takes the action, drives, borrows money, makes investments, approves loans. Party B bears the consequences if things go wrong. The insurer, the lender, the taxpayer, the pension fund. The moment the link between action and consequence is severed, when the person making the risky decision is protected from the cost of being wrong, you have a moral hazard problem. Economists call this an information asymmetry combined with a misaligned incentive. The plain English version is simpler. Someone is gambling with someone else's chips. Now scale this up. Scale it to a bank. It is the year 2005. A mortgage lender in Florida approves a home loan to someone with no income verification, no down payment, and a credit history that should have disqualified them immediately. Why does the lender approve this loan? Not because they are stupid, because they do not intend to hold the loan. Within weeks, that mortgage will be bundled with thousands of other mortgages and sold to an investment bank on Wall Street. The investment bank will repackage these loans into a financial product called a collateralized debt obligation, a CDO, essentially a bundle of bets on whether millions of Americans will keep paying their mortgages. That CDO will be rated AAA, the highest possible rating, meaning extremely safe, by a credit rating agency that is paid by the very bank issuing the product. And that AAA-rated CDO will be bought by pension funds in Norway, insurance companies in Germany, local governments in Australia, investors who trusted the rating and had no idea what was inside the package. At every single step of this chain, the person making the risky decision was protected from its consequences. The mortgage lender sold the loan. The investment bank sold the CDO. The rating agency collected its fee and moved on. The risk traveled invisibly until it landed in the hands of people who had no idea they were holding it. That is moral hazard operating at industrial scale. When the housing market collapsed in 2007 and 2008, the losses were staggering. Lehman Brothers, one of the oldest and largest investment banks in the world, with over 150 years of history, filed for bankruptcy in September 2008, in what remains the largest corporate bankruptcy in American history. The Dow Jones dropped 778 points in a single day. Credit markets froze. Millions of ordinary people lost their homes, their jobs, their savings. And then something happened that showed moral hazard operating at its most dangerous level. The United States government stepped in and bailed out the major banks. The argument was that these institutions were too big to fail, meaning their collapse would be so catastrophic for the broader economy that the government had no realistic choice but to save them. Taxpayers provided hundreds of billions of dollars to institutions that had created the crisis. The banks were rescued. Many of the executives who made the decisions that caused the collapse kept their bonuses. And the message that went out to every financial institution in the world was perfectly clear, whether anyone stated it out loud or not. If you are large enough and interconnected enough, the government will not let you fail. You are, in effect, insured by the public, without anyone asking the public's permission. The moral hazard created by that implicit guarantee, the promise of a bailout, was enormous, because it meant the next generation of bankers could take the same risks, confident that the floor was still there. Here is where it gets genuinely uncomfortable. Bailouts are not irrational. In the heat of a crisis, letting a giant bank collapse really does risk destroying the entire financial system. The people who approved the 2008 bailouts were not naive. They made a calculated choice to prevent a short-term catastrophe, and they probably prevented one. But the long-term price of that choice is a standing invitation to take excessive risk. You cannot simultaneously tell a bank that it is too big to fail and also expect it to behave as though failure is a real possibility. The incentive doesn't work that way. This is why moral hazard is so difficult to solve. The solutions that reduce it tend to create other problems. You can require banks to hold more capital in reserve and money they cannot lend or invest, so they have more skin in the game. That makes banks safer, but it also makes them less profitable and reduces the flow of credit in the economy. You can let failing banks actually fail, withdraw the implicit guarantee, but that risks the kind of cascading collapse that wipes out people who had nothing to do with the risky decisions. You can impose stricter regulations and surveillance, but regulations can be lobbied against, written with loopholes, and eventually eroded. There is no clean answer. Every fix introduces a new tension. That is why moral hazard has been a permanent feature of financial systems for as long as financial systems have existed. So, what do you actually take from all this? 4 things. First, look for who bears the downside. In any contract, any financial product, any government policy, ask yourself, if this goes wrong, who actually loses? If the person making the risky decision is not the person who absorbs the loss, you are looking at a moral hazard setup. Second, too big to fail is not a description. It is a subsidy. Any institution that knows it will be rescued is receiving an invisible guarantee from the public, a guarantee that lowers its cost of borrowing and encourages it to take risk. Every time you hear that phrase, you should hear, this institution has insurance that the taxpayer doesn't know they're providing. Third, insurance changes behavior, not because people are dishonest, but because incentives change behavior. When you understand this, you start reading healthcare debates, housing policy discussions, and student loan programs very differently. Ask, does this protection create the problem it is meant to solve? And fourth, skin in the game is not just a financial concept. It is a design principle. The systems that work best, where incentives are aligned, where consequences flow back to the decision maker, are the ones where the person making the choice also bears the outcome. When you see a system where those two things are separated, you are watching a slow-motion moral hazard problem accumulate. The deepest truth about moral hazard is this: it is not a scandal. It is not a crime. It is what happens when humans, rational, self-interested, incentive-driven humans, respond logically to the system they are placed in. The system is the problem, and the system is always designed by someone. If this made you rethink something, a loan, an insurance policy, a news story about a bailout, hit subscribe. Because next week, we are going to do it again. Drop a comment below. What economic idea or event do you want us to break down next? The best suggestion wins the next episode.